Structured notes with principal back at maturity are structured financial instruments which offer a minimum redemption of at least the principal amount if the investment is held to maturity, subject to risks. These investments have performance that is typically linked to that of an underlying asset, product, or index. These may include market indices, individual or baskets of stocks, bonds, commodities, currencies, interest rates, or a combination of these. Returns from these structured notes can be a fixed coupon or based on underlying performance. For notes based on the performance of the underlying asset, at each coupon payment date, investors will be paid a coupon based on the performance of the underlying asset. For notes based on a fixed coupon, at each coupon payment date, investors will be paid a fixed coupon amount. How does it work? At every coupon payment date, is there a condition for the coupon to be paid? If the condition is yes, the investor will receive a coupon if the underlying asset meets the performance benchmarks. If the condition is no, the investor will receive a coupon on coupon payment dates. Let's discuss using a customer scenario. This note is based on the performance of the underlying asset. Mr. Ng is looking at investing $200,000 in structured notes with principal back at maturity. The tenure of the note is 12 months and the underlying asset is the SPX index. The coupon barrier is at 120%. If the performance of the underlying asset is more than or equals to coupon barrier on the valuation date, the coupon amount equals to the high coupon and offers a return of 5.75% per annum. Mr. Ng will receive $11,500 in addition to the principal amount if the note is held to maturity. On the other hand, if the performance of the underlying asset is less than the coupon barrier on the valuation date, the coupon amount equals to the low coupon with a return of 4.75% per annum. Mr. Ng will receive $9,500 in addition to the principal amount if the note is held to maturity. Let's move on to the next scenario. This scenario pays coupons on predetermined coupon payment dates without the need to satisfy any underlying conditions. Ms. Lee is looking at investing $200,000 in structured notes with principal back at maturity. In this scenario, the coupons will be paid out yearly to the investor on the predetermined coupon payment dates. At year 1, the fixed coupon paid is at 4.50% per annum. At year 2, the fixed coupon paid is at 4.60% per annum. At year 3, the fixed coupon paid is at 4.7% per annum. Ms. Lee will receive a total of $27,600 in coupon across the tenure of the note and her $200,000 principal amount if she holds the product to maturity. Why invest in structured notes with principal back at maturity? Investors can use structured notes with principal back at maturity to express their market views, as it can offer asset class exposure without directly purchasing into the underlying asset. These products are suitable for investors with low to moderate risk profiles who wish to participate in the performance of underlying assets and yet do not wish to lose their principal at maturity. The note is matured and the principal amount is returned if the note is held to maturity, subject to risks. Some of the key risks of structured notes with principal back at maturity include the following: credit risk, liquidity risk, market risk, and early redemption risk. The above risks are not exhaustive nor mutually exclusive. In the worst case scenario, investors may not receive the full initial investment amount back at maturity due to a combination of these risks. To find out more, speak to your Standard Chartered Bank relationship managers today.